it does take us to our talk of the tape, how to invest in the second half. Well, let's ask Cameron Dawson, Chief Investment Officer for NewEdge Wealth, with me here at Post 9. Welcome back. It's good to see you.
Good to see you.
So what's up with today's action, right? The PCE came in line. No surprises whatsoever. Yields are elevated. And after hitting these new highs for the S&P and the NASDAQ, we kind of rolled a little bit.
Yeah, we are extended and overbought, and maybe that is a little bit of what's going on, which is that the PCE was good. It was right in line. You did see some revisions higher in last month, so maybe that caused people to say, oh, all the data isn't great. But we have to respect the fact that though the trend is higher, in the very short term, you are hitting this wall. We're in the blackout period for share repurchases. You're overbought. You have very extended valuations positioning. It's not surprising to see this little bit of a breather. We'll see if it continues, though.
You know, I don't know if you were one of the voters in our Delivering Alpha quarterly poll here, but we did ask people what's next for stocks. 36% say we're due for a drop of 5% or more by autumn. Now, it's always hard to read into that because you could say, well, we haven't had hardly any volatility, and we're only due for a drop because we really haven't had a drop. Yeah. And when we have, it hasn't been even 5%. So what does this all mean for where we go from here, do you think?
I think that some of this momentum can continue into July. We do know seasonals are typically supportive in July, but then you start getting into August and September, and you start looking around at some of the things that could drive the market higher. One of the things we're talking about is that earnings for 25 are starting to look really aggressive, very elevated, and that's when you start seeing analysts roll forward their models and consider, are we properly calibrated for 2025? We've also seen this deteriorating in some of the economic growth. Atlanta Fed GDP now was just revised down to 2.2%. So how does that square with GDP forecasts, which still remain elevated?
So is this one of the biggest risks then, that earnings are too optimistic at a time when valuations are already what you would say are historically elevated?
Yeah, that's the high bar to jump over, which is that valuations have already priced in great news, earnings are pricing in great news. Now, the point is that earnings are still moving higher for 2025, and your 12-month forward numbers are still trending higher. That's why this market remains so resilient. The question is, if you start revising those numbers lower because you're revising GDP lower, or you're saying that certain expectations are too aggressive, like margin expansion, which has in at 100 basis points, incredibly aggressive, if those start to be revised lower, that's when we think you could hit more of an air pocket in the market.
I've heard people make the argument that rate cuts, you don't want them, because at this point it's going to mean that something's wrong, that the economy's slowing, that maybe it gets to the point that the Fed has to step in rather than wants to step in at that moment because they're not fully confident that inflation is close enough towards target.
Rate cuts because you can are great. Rate cuts because you should are bad. And one of the things that we're seeing is finally starting to see the impact of higher rates on this economy. Look at the housing data. Look at the capital goods, the durable goods. You're starting to see this weight of higher interest rates on some economic activity. It's not bad enough yet to call and pull the recession alarm. We don't think we're slipping into a recession, but it is enough to suggest that maybe growth forecasts are a little bit too high.
That says to me you probably think it's too soon to expect much broadening out of this market.
I think so. The thing that has been the key driver of the narrowness of the market has been earnings narrowness. The S&P equal weight earnings have continued to be revised lower, whereas the Mag 7 continued to be revised higher. If you look in the back half of the year, though, the bar is highest for the 493 of the S&P 500. The consensus has those estimates going up to the high teens in the third quarter, the fourth quarter, and the first quarter 2025. So that's actually room for further disappointment. So unless there's a good earnings reason for the market to broaden out, we don't think it will.